Okay. So what do we mean by this market efficiency? So always whenever we operate in a market, we should ensure that the market is efficient from the various perspectives. By that, the confidence and as well as the transaction cost in that particular market will be relatively conducive for the market participants. So that's why if you see the overall meaning of the market efficiency, that means any kind of factors which are utilized in this particular market, and as well as the allocation of the factors for productivity or for the output maximization should be in a basically in an effective way or in a productive way. So it is basically the use of the factors and the allocation of the factors which are available in the system. I am talking about in general definition of efficiency. So whenever you talk about the financial market, here, whenever, for example, you have taken this instrument like stocks. So whenever you are buying the stock or you are selling the stock, on an average, the return what you are getting, the return should compensate the risk what basically you are exposed. So the risk return trade-off should be always, the risk should be compensated by the return what you are getting from that particular market. That basically one efficient market will help you to do that. But what happens if the market is inefficient, then sometimes some group of investors, some group of market participants will get very high returns, and they can create this huge arbitrage opportunity in the market. By that, they can create enough money in that particular system. But whenever you talk about the other investors, other group of investors, they may not generate extra profit or any kind of normal profit from the market also. So market inefficiency will have a kind of concept which basically helps certain group of the people to generate some extra profit, but other group of the people may not get that kind of return or the profit from the market. And whenever this market is inefficient, there is a opportunity of arbitrage. So what do you mean by arbitrage? Anybody can tell me? I have used this word arbitrage opportunity. What do you mean by this arbitrage opportunity?
So like you can buy something from somewhere on a lower price and sell in the other place at a higher price.
Higher prices.
In the
Okay.
yes, sir.
Okay. Is there any other factor also there in that particular? Are you foregoing any other factors? You are talking about you are buying, for example, today I will buy something at a price of 10 and tomorrow I will sell it at a price of 20. Can I say that it is arbitrage?
No, sir, it should be simultaneous.
It should be simultaneous. That means at a particular point of time. Am I right? Yes or no?
Yes.
Yes? Anybody? Abhidev? Time is here important or not?
Yes, sir.
Yes or no?
Yes,
Yes?
sir, it's important because if we sell at any other time, then at that time market price can also increase, like decrease. So then it won't be called arbitrage.
Yeah. So arbitrage means basically you are basically taking both the positions simultaneously. What basically she was telling, both buying and selling positions in a particular kind of security or particular kind of instrument with a price differences at a particular point of time. For example, you have bought a stock. Let you have invested in the equity market. You have bought a stock from Nasdaq Stock Exchange, or maybe in India, we can take the example of NSE, National Stock Exchange. From the National Stock Exchange, you have bought a stock at a price of let 500 rupees. And immediately, at same time, you find that this particular stock is traded in Bombay Stock Exchange at a price of 510 rupees. Then what basically you can do? Simultaneously, you are buying that particular stock from NSE and immediately we are selling that stock in BSE, then per stock we are generating a profit of 10, which is riskless. That is basically, we call it the riskless profit. The arbitrage opportunity is created with two conditions, or we can define the arbitrage opportunity in this way: whenever we are generating a riskless profit by taking both the positions, both buying and selling positions in two different markets at a particular point of time, then as well as we have to consider there is a unique price difference prevails in that particular two different markets. That's why we call it, there is a law of one price. You keep in the mind, there is a concept called law of one price. That means for a particular commodity or a particular kind of instrument, the price should be same across the markets at a particular point of time. If there is a price differences in that particular point, then there is a chance of arbitrage opportunity, or this investor can create certain riskless profit. So that's why time is very important in this case. So that is called the arbitrage. And this arbitrage opportunity basically will be more prominent whenever there is some kind of market inefficiency always prevail in the system. So that is what basically always we want to know, or we should always see. So whenever we say that the market is efficient, obviously, like your perfectly competitive market and all whatever you have studied, you might have seen that there are certain conditions the efficient market always we always experience. One is your large number of participants, large number of competing profit maximizing participants, and one participant is not influenced by the other participant. One participant is not influenced by the other participant. That means they always take their decisions independently. There is no dependency prevailed between the two different kind of groups or different kind of individuals who basically always participate in the market. That is the first thing. Second thing is active participation in the market. That is very important. What do you mean by the active participation in the market? For example, somebody has started investing in the stock market. He has invested 1 lakh rupees and forgot. He is not bothered about the market fluctuations, or he is not going to change the positions in the market. He is not studying the market to get this opportunity or profit opportunity which is created. So in that case, that investor is not an active investor. He is an investor who is basically inactive in the market, but he has taken the positions. So the active participation is very much required, or is a precondition to understand that the market is efficient or not. So that's why active participation in the market is very important by the market participants. Any individual cannot affect the market prices. Any particular entity, if they will change their position, then the market price should not be highly fluctuating, should not change drastically. They should not control the price. If a group of individuals or a large group of investors change their positions, there is a possibility of fluctuations in the prices. But if any individual can influence the price, that means your market is not competitive and the market is inefficient. And the informations what we get from the market, that should be free. That should be free information. And another one is that free entry and exit by the market players. At any point of time, we can enter the market. At any point of time, we can exit the market. That is also another requirement or another condition we have to keep in the mind whenever you are trying to define the concept of efficient market. The free entry and exit. But you see that, yes.
Sir, in this, you said that information must be free. That includes the information from the peer investors also.
No, I'm talking about the informations about the company,
Uh,
informations about the market fundamentals. There should not be any gap about let you have some access to the some group of managers in the company, then you have better information than me. That thing should not prevail. But what your peer is thinking, or what actually Abhidip is thinking, that is not required that you should know that what kind of thing he is doing. That is not required. That is not the condition. It is the condition is whatever informations are available to you, the same information should be available to Abhidip, and accordingly you can use that information to take your position in the market.
Okay, sir. Got it. Thank you.
So that is what basically always we always define. So these are the different conditions what we basically always try to explain. The concept of market efficiency was coined in 1959. Mostly people have always give the credit to pharma, using pharma for the concept of efficiency, but in general, in aggregate sense, the concept of market efficiency was largely coined by the person James Tobin. James Tobin, who is a Keynesian economist, who was given, all of you have heard about his name in terms of different theories you might have read in macroeconomics also. So Tobin had said there are five types of efficiency. What are those five types of efficiency? You remember, these efficiency is related to the aggregate holistic market. It is not basically only related or confined to a particular market. So according to Tobin, there are five types of efficiency. One is information arbitrage efficiency. Then you have the fundamental valuation efficiency, full insurance efficiency, functional or operational efficiency. Then you have the allocational efficiency. So these are the different type of efficiency concept what Tobin has explained. Already I told you that information arbitrage efficiency means which is the most important thing people always consider, particularly from the financial market point of view. Whenever we refer to the financial markets, always we give lot of attention, lot of importance to the concept of the information arbitrage efficiency. So what this information arbitrage efficiency is all about? How do define this information arbitrage efficiency? You see, all those commonly available informations which are there in the market. What is the company's profit? What is the total turnover of the company? Where the company is based? What is the last 2 years, 3 years performance of the company? So all type of what kind of events have occurred within the company. So all those information should be available equally to everybody. If that information, just now what Utkarsh was asking, if those informations are available to everybody, then what will happen that no group of individuals, no group of investors can get more return or consistently get more return than another group. That may be a return variations. The return variation will be there because of your expertise, how you are utilizing that information. But the return variation should not be that much by that one group will consistently get more return than the other group. But if one group of individuals have more information, then what will happen that those people will have always utilizing that particular information to get more return. All of you have heard about the Harshad Mehta scam? Yes or no?
Yes, sir.
So that particular scam, if you see, that is totally a clear example of information arbitrage efficiency. Because Harshad Mehta could get more information from various sources, and which was known to other group of individuals or other kind of market participants. Then he was able to utilize that information and accordingly generate more profit. So that was in which way he was collecting the information or he was able to get the information, that is a different story. But if you talk from the financial point of view, or you are talking about the pure academic point of view, then we can always say he was able to generate more profit, more return because of the availability of the information to him. Because whatever information he has, the other market participants did not have that particular point. So because of that, he could utilize that and get more profit. Second point is that fundamental valuation efficiency. What do you mean by the fundamental valuation efficiency? Fundamental valuation efficiency in a theoretical sense, if I tell, it is a theoretical concept, I can tell you. Here, the market price of a security should be equal to the intrinsic value or the investment value. So what do you mean by the intrinsic value? Any one of you can tell me what is intrinsic value? Can you give an example of intrinsic value? Yes? No? Anjali? Aman? Ayush?
Yes, sir.
What do you mean by intrinsic value?
सर एसेट का वर्थ मतलब क्या है मतलब
मैं एक तुमको एग्जांपल देता हूँ. एक 5 रुपीज कॉइन है, तो 5 रुपीज कॉइन का इंट्रिंसिक वैल्यू क्या है?
5 रुपीज है सर.
5 रुपीज है, तो उसका मार्केट वैल्यू कितना है?
5 है सर.
तो इंट्रिंसिक वैल्यू भी 5 है, मार्केट वैल्यू भी 5 है.
हाँ सर.
आर यू श्योर?
हाँ सर.
All of you are agree with him?
Sir, I think that intrinsic value will be the value of the metal. That it's
Good. It is the value of that particular coin or the value of the metal and other kind of expenditure which has been used or which has been utilized or which has been incurred to make that particular coin. That is called the intrinsic value. And the market value of that particular coin is 5 rupees. Is it clear? Yes?
Yes, sir.
Sir, is it like the cost of making that coin?
Sorry?
Sir, the intrinsic value. You gave an example of a coin, 5 rupee coin. You said that the intrinsic value is the value of the metal in that and the cost. So is it like the manufacturing cost of anything, the intrinsic value?
It includes basically to prepare that coin, how much cost we have incurred, right? It includes the metal cost and as well as the other kind of machinery cost and other kind of cost what basically we're incurring. If you add up these three, that is all these things, you can say that that is the intrinsic value of that. And so, go ahead.
So like for anything, if a firm makes some product, so the cost they have to incur is the intrinsic value and the price that they sell.
See, intrinsic value concept in the financial market is different, but for your understanding, I have given that the fundamental value of a particular kind of product, if you are not generating any extra amount of profit or any kind of price discrimination is not there, then you'll find that this particular, if you are incurring 100 rupees cost for making that product, then the price of the product should be 100 rupees if you are not making any profit. So that 100 rupees, you call it the intrinsic value. So that's why I've given the example for your understanding that 5 rupees. But the 5 rupees coin market price or market face value of that particular coin is 5 rupees. But the intrinsic value of that coin may not be 5 rupees, or it may be more than 5 rupees, it may be less than 5 rupees. That is what basically what we can say it. But whenever we talk about the financial products, the financial products intrinsic value are calculated on the basis of the expected cash flow what we are generating from that particular asset. Whatever cash flow we are generating, the cash flow has to be discounted with respect to discount rate. Then we expect that, okay, the price of the product should be this much. The price of the product should be this much. Then after that, actually this particular price in the market may not be this much. That actual price may be different from that particular price, whatever we have calculated. So that's why there may be a difference between the actual value, whatever we have calculated, and this particular price which is prevalent in the market. For example, if you say a stock, right? If you talk about, for example, if you talk about a stock, Then what is the stock? How do you calculate the intrinsic value of a stock? Anybody can tell me?
Sir, discounted cash flow method.
Discounted cash flow. Which one you will discount?
Sir, all the expected cash flows will be discounted.
तो स्टॉक से क्या कैश फ्लो मिलता है?
Dividends.
Is it the
Dividends.
net present value?
Yeah, it is basically your present value of the cash flows. It is the present value of the cash flows. Generally, we discount it with respect to the particular discount rate. Right? So generally, whenever we calculate this, for a stock, whenever you calculate, we write it basically. If you will discuss more, but I can tell you it is D1 divided by your R minus G. D1 divided by R minus G. Assume that what is the D? D is the dividend. D is the dividend. R is equal to your discount rate, and your G is equal to the growth rate of the dividend. Right? So in that case, we are assuming that the cash flow what we get from the particular stock, that is the dividend. So D1 is nothing but D0 into 1 plus G divided by R minus G. We are assuming that the growth rate of the dividend is constant. So the growth rate may not be constant, it may also vary across the time. But if you assume that the growth rate is constant, and this is the formula, what basically we can use it. D0 into 1 plus G divided by R minus G. But in general, if you just now for our understanding, we can say if you discount your cash flows over the time, then we calculate the present value. And this present value of the cash flows, expected cash flows, what we get it from that particular stock or particular kind of asset, then that basically will be the intrinsic value. That is basically your intrinsic value. So there you can write it CF1 divided by 1 plus R plus CF2 divided by 1 plus R to the power 2 plus CF3 plus divided by 1 plus R to the power 3 and so on. So that is what basically what the way we calculate the present value of that particular cash flows. Then finally we calculate this intrinsic value of that particular asset. And here, but whenever we go, for example, you take the example of a stock, let us stock A. So you, whenever you the stock A, you find out the dividend and you find the growth rate of the dividend, you calculate that the intrinsic value of that particular stock is at 500 rupees. But in the market, you find the price of the stock maybe is traded in the market as a 600 rupees, or it may be traded as a 450 rupees. Then why there is a deviation? The deviation is there because of many other factors. It may be because of the behavioral factors, or maybe because of some of the intangible factors, brand, all kinds of other factors will come into the picture. That basically always we should understand whenever we talk about this how to determine the market price of a particular asset. But my question is that what Tobbins basically was trying to say. Tobbins says that whenever we talk about this fundamental valuation, the market price and the intrinsic price of the particular asset should not be different. Should not be different. If your market is really efficient, the system is really efficient, then all this particular discount rate and as well as cash flow, what you are getting or what you are utilizing for calculation of this intrinsic value, that basically will give you a kind of accurate picture that what should be the market price, which is not practically possible. Which is not practically possible because there are many factors which are affecting the market price of a particular asset, but those things are not reflected through the discount rate and other kind of cash flow what we are using, because these are all the approximations what we make. Because dividend, for example, in the stock, dividend is not the only cash flow. There is a capital gain and other kind of cash flows also involved with respect to that. So it is difficult to accommodate all the factors or all kind of concepts which are utilizing or which are used for calculation of that particular intrinsic value. So that's why there is a difference in terms of the intrinsic value and the market value. That's why all the markets in true sense fundamentally not efficient. But that is the concept you have to keep in the mind, The fundamental valuation efficiency means whenever the present value or the intrinsic value of the particular stock or particular asset should be equal to the market price. Then the third thing, what basically again it is also difficult concept. Theoretically it is maybe true, but practically it is not possible. That is called the full insurance efficiency. What do you mean by the full insurance efficiency? The full insurance efficiency means the extent of hedging against possible future contingencies. The greater the possibility of hedging and reducing risk, the higher is the market efficiency. That means whatever positions, whatever investments you are making in the market, so any kind of risk what you are basically exposed to, that particular risk should be perfectly, or there is a possibility of hedging all type of risk what you are going to face. So that means the insurance, basically the risk can be managed. There are many ways the risk can be managed. One is your hedging, another one is the insurance, another one people call it the speculation. But speculation is again a risky proposition. So mostly the insurance and the hedging, these are used for basically to manage the risk. What do you mean by hedging? Yes, anybody can tell me what is the meaning of hedging?
सर जो मतलब ट्रेंड के हिसाब से अगर ट्रेंड पलट जाए तो उसको रोकना, मतलब टाइप कुछ उसके लिए करना।
एक एग्जांपल दो रे आयुष, एक एग्जांपल दो
सर। मतलब एक मान लीजिए कोई स्टॉक का प्राइस बढ़ रहा है लेकिन कुछ अचानक से हो गया, तो उसको प्रोटेक्ट करने के लिए कोई ऑप्शन ले सकते हैं। तो
क्या लोगे? तो किसको लोगे तो?
सर तो
स्टॉक का रिस्क को मैनेज करने के लिए तुम कौन सा एसेट को रखोगे बाय दैट कि योर रिस्क कैन बी हेज्ड आउट?
सर डेट को रख सकते हैं, डेट फंड को, या तो सर कोई कॉल ऑप्शन लोअर ले सकते हैं अगर स्टॉक मार्केट का कोई।
तो डेरिवेटिव्स इंस्ट्रूमेंट में इन्वेस्ट कर सकते हो, राइट?
हाँ सर।
ओके, सो इज देयर एनी अदर इंस्ट्रूमेंट व्हिच कैन बी यूज्ड एज a hedging? Gold. Okay, so in general hedging means, can you define the hedging? Are you getting any extra return through hedging, or you are only making your, it is a kind of whatever loss you are making in one segment, you are going to gain the same amount in another segment. That's why your loss and gain is cancelled out, and finally wherever you are. That is called hedging. Kaustav?
Yes sir, the second one.
So that means we are not going to get any extra return, but whatever money we have put on the market, that particular money is not basically is going to be reduced, or the return what we are going to expect, that is not going to be reduced. That basically concept is called the hedging. And insurance is basically kind of risk transferring. Whenever you are basically going for insurance policy, basically there is insurance benefit what you are getting, that is the transfer of particular money from one particular individual or particular segment to another segment. So that's why what this full insurance efficiency talks about. The full insurance efficiency says that whatever investments or whatever positions you are making in the market, those kind of exposure should be perfectly hedged out, or there should be enough instruments or enough kind of avenues should be there in the market. By that we can or we'll be able to hedge out the risk whatever we are exposed to. So that is basically called the full insurance efficiency.
Sir, can you
not practically
explain
true.
hedging? Sir, can
Yes.
you explain hedging a little more? I didn't quite get it.
Okay.
Yes, sir, me too.
You too. Okay. Let me give you a very simple example. He has given Kaustav was telling about the gold. Why people say that gold is a hedging instrument? It is not a return maximizing instrument. It is a hedging instrument. तुम अभी gold खरीदे, let for 10 gram you have bought it at a price of 45,000 rupees, right? So after 1 month, if the gold price has increased or decreased, so if you say that depending upon the price fluctuations, always we say that whether we can get more return from the gold or not. If you are only investing in the gold, if the price, let your objective is to sell the gold in the future, get some return. So if the gold price will increase, then you can sell it, get a return from this. But if you are not, the gold price has come down, then you cannot, if your objective is to get some return in terms of selling the gold, you may not get this. It's same thing, but here we are assuming that gold is an hedging instrument. For example, somebody has invested in the stock market. If you have invested in the stock market, for some reason, let you have invested 5 lakhs rupees in the stock market in a particular stock, the stock price is 1000 rupees. Then in that case, the 500 stocks you have bought, and next day, or next 15 days, the price has come down. The lead price has come down to 450, but you have bought at the price of 500. So for each stock, you are incurring a loss of the 50 rupees, right? But you find that if you continue for holding that particular stock, further may stock price again go down also. But all of you might have seen the trend, or there is a logic for that also. Against the stock market, the hedging instrument, one of the hedging instrument is the gold. Because if the market is going down, then the price of the gold increases. If the market is going down, stock market is going down, then the price of the gold increases. If the market is going up, then the gold price will come down. So there is a kind of substitution always happens between these two, because whenever people find that enough profit opportunities are not there in the stock market, they invest their money in the gold. So if the market has gone down, then what example we have taken, that the price has come down from 500 to 450, then 50 rupees per stock you are losing. Let in the same way, the gold price has gone up and you are holding some gold also, and you are able to sell the gold, assume, in the market at a higher price, whatever you have incurred in the stock market for stock 50 rupees, the same amount of return or same amount of profit or same amount of kind of gain you can create by selling the gold if you have already hold the gold with you. Are you getting my point?
Yes, sir.
So what basically we are telling, that I may not get high return. I am not telling that the return will be maximizing, but I am not going to incur the loss. I am not going to incur the loss. I may not get high return. So that instrument, any instrument which helps us to make this kind of zero-sum game, your loss will be compensated by the gain. So that kind of instruments are called the hedging instruments.
Sir, how is it different than diversifying the portfolio?
Diversifying the portfolio, the objective was not to basically hedging. The diversification of the portfolio is to basically minimize the systematic risk. Sorry, unsystematic risk. Sorry, not systematic risk. It is basically to minimize the unsystematic risk. Instead of holding a single stock, if you are holding 20 stocks, or you are holding a combination of the stocks and bonds, then what basically you will find that to some extent your objective is to maximize the return. Your objective is not basically to make the return zero, or wherever you are, basically you are keeping your money in that particular position only. Yatharth, are you getting my point?
Yes, sir, got it.
So portfolios composition is basically made to minimize the unsystematic risk, and there this investor's objective is to maximize the return only. But whenever we are going for hedging, our objective is not to maximize the return. Our objective is to basically to compensate the loss in one segment by gaining in another segment. But portfolio mein you can also get more return. Not necessarily that it will be perfectly somewhere you will gain, somewhere you will lose. That is what and portfolios are basically many types. Diversification may not be always on the basis of the combinations of the different type of assets. Diversification also within the asset from the different other sectors and other kind of stocks, other type of bonds. So that's why the objective of the portfolio is different than the objective of the hedging strategy. Okay, so that is what, again, I said that it is again theoretically not possible to completely hedge out the risk, but we can minimize the risk through this hedging process.
Sir, is hedging usually done in the short term or long term? Like in the long term, if we see the gold price and stock price both can increase, right?
Hedging is a process of short term concept. Hedging generally market में hedging को हम लोग use करते हैं. स्टॉक मार्केट में कोई गोल्ड को लेके ज्यादा हेजिंग नहीं करता है. मोस्टली पीपल यूज द डेरिवेटिव्स इंस्ट्रूमेंट फॉर द हेजिंग. Okay, generally the derivatives, I will discuss more on that, how it is basically used and all, but these are the ways the hedgings basically are done, and it is a short term concept, not a long term concept. Okay, generally 3 months period, right? Then we have the functional or operational efficiency. What do you mean by this functional or operational efficiency? Here, if the market is operationally efficient, when we can say that the market is functionally or operationally efficient? Whenever the transactions or the administrative cost in the market is very low. Okay. So if somebody wants to borrow the money, somebody wants to lend the money, somebody wants to buy the stock, somebody wants to sell the stock. So all type of activities, what basically always we see in the financial market or any other market. So those things should be done in a very effective way. There should not be any kind of administrative hassles, or the administrative cost should be less, and as well as the transaction cost also should be less. If the transaction cost and administrative cost will be less, we can say that the market is operationally or functionally efficient. And the last one is the allocational efficiency. Here, how to basically channelize the resources into the investment projects. We have to find out the appropriate investment projects where the marginal efficiency of the capital. What do you mean by the marginal efficiency of the capital? MEC क्या है रे? Yes. What
dq upon dk, like partial derivative of
बताओ क्या वो है, क्या कॉन्सेप्ट क्या है?
increase in the output with respect to increase in capital, like how much the output is increasing if
you are increasing the 1 unit of the capital, right?
Yes, sir.
So that is called MEC. Yes or no? Marginal anything marginal efficiency, how your capital is going to be increasing due to the increase in the capital, and that should be also adjusted to the risk. So whenever we are, for example, you are talking about the financial capital. So whenever you are investing 1 unit of the rupee you are spending on a stock extra, then how much basically return you are going to get, and as well as how much risk you are also exposed to. That risk also should be adjusted to that. So if you are really allocating your resources in an effective way or in an optimal way, then your marginal efficiency of the capital can be maximized or can be the highest. So if you are getting a highest marginal efficiency from that particular system, then we can say that that particular market or that particular kind of segment is allocationally efficient, or there is allocative efficiency which prevails in that particular system. So in general, if you see, there are, but in today's context, I already told you, in financial market particularly, we have given much attention always we give, particularly to the information arbitrage efficiency. It is the most important concept always we consider whenever we refer to the services sector or mostly the financial markets. So in that case, if you consider that thing, it is basically kind of two issues always we try to address whenever we discuss about the efficient market. How well do markets respond to new information? If any information comes to the market, let government has introduced certain new policies, let some kind of announcement has been made in the budget, or any kind of international event has occurred, maybe because nowadays the markets are highly integrated, so any kind of international event has occurred. So there are many ways the events can always happen in the market, or any kind of new information can always be flown into the market. So if any particular news or particular event or particular information comes to the market, how the market, or how effectively or how easily or how quick the market is responding towards that. That is first issue. Secondly is that, is it possible to decide between a profitable and unprofitable investment given the current information? So whatever information is available to you, whether that information is sufficient enough to understand what is the profitable opportunity and what is a non-profitable opportunity. So that basically concept is always discussed in the context of the efficient market. So keeping that thing in the mind, see, there are the efficient market hypothesis has been formulated. The efficient market hypothesis, already again and again I am telling you, this hypothesis mostly talks about the concept of information. So that means what this efficient market hypothesis tells, which is given by Fama, who is a Nobel laureate, he received the Nobel because of this. What basically Fama tells, the current prices of securities, Fama has done a lot of contribution to the finance literature. He has talked about the efficient market hypothesis, talked about the pricing of the assets and all these things. So first time, whenever he said that the current prices of securities reflect all information about the security. Whenever you look at a stock, let the price of a stock is 500. That 500 reflects all the things about the company, and all the informations are reflected through that particular price. Number one. Number two, any information which is coming to the market, new information particularly, that should come to the market in a random fashion. Somebody cannot predict before that what is going to come to the market. So if the information is random, then this information is reflected through the prices, then the price also should be random. The price also should be random. Then the third thing is basically what we're trying, then the profit maximizing investors adjust the security prices rapidly to reflect the effect of new information. That means how quick the market is to capture that information. And the return what we are getting from this, from that particular asset, should reflect its that will be reflected in that particular kind of stocks or particular kind of price of that particular asset, and how quickly I am adjusting the prices, or the prices is able to capture this information. If it is a good information, the price will be up. If it is a bad information, the price will be down. But if your market is really efficient, the adjustment does not take much time. In today's context also, if you observe, because of the technology and the other kind of efficient systems, whatever we have we'll observe that something has been announced by the monetary authority or announced by the government, immediately it will be reflected in the prices. You might have seen that there is a budget day. If you see that, you might have seen in the news and all these things, the finance minister reads the budget. So immediately that whether any positive or negative, whatever news basically you can imply from that particular kind of budget, that will be reflected in the market fluctuations or on the market prices. So that basically should always be reflected in the prices. So any investor who wants to invest in that particular segment, that investor should always feel that that thing should be always is the actual price what is prevailed, and by that he will not be in a trouble. So there are three forms of market efficiency, what Pharma has basically talked about. So if you talk about the market efficiency, different forms of market efficiency, the market efficient hypothesis or efficient market hypothesis, in short what we call it EMH, it tells that to what extent do securities markets quickly and fully reflect different available informations. How quickly and to what extent these particular securities or informations are basically reflected in the prices. So in this context, he has talked about the three levels of market efficiency. One is your weak form of efficiency. Second one is the semi-strong form of efficiency. And third one is the strong form of efficiency. And these different levels of market efficiency are designed on the basis of the types of informations. One is what we call it the publicly available informations. Other one is the private information. So depending upon the nature of informations, that we should always see that how this different level of market efficiency are defined, and how we can say that whether the market is weakly efficient or semi-strongly efficient or strongly efficient. What are the different kind of empirical methods which are used to examine whether this market is in what form the market is efficient. There are different type of statistical tests which are used, or different kind of methods which are used to examine whether your market is weakly efficient or semi-strongly efficient or it is strongly efficient. This is this part we will discuss in next class. Then we can complete the first module and we move towards the other aspects. Okay, so we can stop here. And already I told you that your quiz